Hello and welcome to Mr. Vin TV, where we tackle intriguing economic topics. Today, we're venturing into a subject that touches us all, yet remains shrouded in complexity: inflation. We'll be unwrapping the layers of this economic phenomenon, giving you a clearer picture of what it is and how it impacts our lives. Particularly, we're focusing on how inflation affects future generations. So, are you ready to take a deep dive into the world of inflation? Stay tuned. First, we need to understand what inflation is. Simply put, inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. To wrap your head around it, imagine you have $1 today. Over time, as inflation increases, the value of that dollar decreases. This means that $1 today won't buy the same amount of goods or services in the future. Inflation is typically measured by the Consumer Price Index, or CPI, which tracks the prices of a basket of goods and services over time. However, it's important to keep in mind that the basket used isn't static. It changes to reflect shifts in consumer preferences, technology, and market trends. So, what causes inflation? There are a few key players, but two of the most common are demand pull and cost push inflation. Demand pull inflation occurs when demand for goods and services exceeds their supply. Imagine everyone suddenly wanting to buy the latest smartphone, but there's a limited stock. The price would likely go up, right? That's demand pull inflation in action. On the other hand, cost push inflation arises when the costs of production increase, causing producers to raise prices to maintain profit margins. For instance, if the price of oil goes up, it'll cost more to manufacture and transport goods. Those added costs are often passed on to consumers, leading to inflation. But inflation isn't inherently bad. In fact, a moderate level of inflation is often viewed as a sign of a healthy economy. It can stimulate spending, as people are more likely to buy now rather than later when prices might be higher. However, when inflation becomes too high or unpredictable, it can create economic instability and erode purchasing power, which can be particularly challenging for those on fixed incomes. Now that we understand what inflation is, let's explore how it impacts future generations. Inflation doesn't just affect us now. It also has profound implications for future generations. Let's delve into this topic and explore how inflation can shape the financial landscape for those who come after us. In simple terms, inflation is the rate at which the general level of prices for goods and services is rising, and subsequently purchasing power is falling. So what does that mean for future generations? Well, it's all about purchasing power. In an inflationary environment, the value of money decreases over time. This means that the same amount of money will buy fewer goods and services in the future. Imagine, for example, that a loaf of bread costs $2 today. If inflation continues at a steady pace, that same loaf might cost $3 in a decade. For future generations, this means they will need more money to maintain the same standard of living that we have today. Their salaries will need to keep pace with inflation, or they will find themselves unable to afford the same goods and services. Moreover, inflation doesn't just impact purchasing power. It also affects savings and investment. Let's consider savings first. If you put money into a savings account today, and the interest rate doesn't keep up with inflation, the value of those savings will decrease over time. This is a major concern for future generations, particularly as they start to think about long-term goals like retirement. If their savings are not growing at a rate that outpaces inflation, they could find themselves with a shortfall when they are ready to retire. Now, let's turn our attention to investments. Inflation can be a double-edged sword in this realm. On one hand, it can erode the value of fixed income investments like bonds. If you buy a bond with a fixed interest rate and inflation rises, the real return on that bond, the return after accounting for inflation, will decrease. On the other hand, some investments, like real estate or stocks, can potentially provide a hedge against inflation. These assets can increase in value over time, potentially at a rate that outpaces inflation. However, these investments come with their own risks, and future generations will need to balance these risks with the potential rewards. In essence, inflation poses a complex challenge for future generations. It impacts their purchasing power, their savings, and their investments. It can dictate the affordability of everyday goods and services, influence the value of their long-term savings, and shape their investment strategies. So, as we can see, inflation can have a significant impact on the financial future of coming generations. It's a critical factor that will shape their economic realities, and understanding it is the first step towards navigating its challenges effectively. Let's put this into perspective with some real-world examples. In Germany, we find one of the most notable instances of inflation. After the First World War in the early 20s, the Weimar Republic was burdened by war reparations. To cope, they began printing money, leading to hyperinflation. The price of everyday items skyrocketed with a loaf of bread, which cost a few marks at the beginning of the year, costing billions by the end. This economic chaos sowed the seeds of discontent that eventually led to the rise of the Third Reich. Moving on to Zimbabwe, a similar story unfolded in the early 21st century. The government, under Robert Mugabe, started printing money to fund various projects. This led to hyperinflation, with prices doubling almost every day. At its peak, a loaf of bread cost a staggering 100 billion Zimbabwean dollars. The impact of this economic disaster is still felt today, with the country struggling to recover and future generations bearing the brunt of the past economic decisions. In Venezuela, we are witnessing a similar situation unfolding in real time. Over the past decade, the country has seen its currency lose value at an alarming rate due to poor fiscal policies and rampant corruption. This inflation crisis has resulted in shortages of basic necessities and a mass exodus of people seeking a better life elsewhere. The future generations of Venezuela face an uphill battle to recover from the economic devastation. These instances of inflation gone awry highlight the importance of sound fiscal and monetary policies. They serve as a stark reminder that unchecked inflation can lead to social and political upheaval and economic collapse, affecting not just the current population, but future generations as well. However, it's not all doom and gloom. Inflation, when managed effectively, can contribute to economic growth. For instance, the United States has seen average annual inflation rates of around 2 to 3% for the past few decades. This controlled inflation allows businesses to raise prices and wages gradually, promoting investment and growth. It's a balancing act where the right amount of inflation is beneficial, but too much can lead to disaster. So, how do future generations in these countries fare? In Germany, the memory of hyperinflation is still very much alive, shaping the country's fiscal policies and its approach to European economic matters. In Zimbabwe, the economic recovery is slow, with future generations still grappling with high unemployment rates and a struggling economy. In Venezuela, it's too early to tell, but the signs are not promising, with a generation growing up in a country in crisis. These examples provide a stark illustration of the potential long-term effects of inflation. In the next scene, we'll explore how to mitigate the effects of inflation, so stay tuned. While inflation can seem daunting, there are ways to mitigate its effects. One of the most effective strategies is investing in assets that appreciate over time. This could mean buying real estate, as property values typically rise alongside inflation. Similarly, investing in equities or mutual funds can be a savvy move, as companies generally increase their prices in response to inflation, leading to higher profits and stock prices. Another strategy is to store wealth in commodities like gold, which are known to hold their value over time. This can act as a hedge against inflation. Additionally, bonds that are indexed to inflation can be a good option. These bonds are designed to increase in value along with inflation, ensuring the purchasing power of your investment remains constant. Finally, keeping your skills up to date and in demand can help ensure your income keeps pace with inflation. So, while inflation is a reality, we are not helpless against its effects. We've covered a lot of ground today on the topic of inflation. We've unpacked its meaning, delved into how it impacts future generations, and explored real-world applications. Importantly, we shared strategies to mitigate its effects. Knowledge is power, and understanding inflation can help us secure a more stable economic future. Don't forget to subscribe to Mr. Vin TV for more insightful videos on economics. Thank you for watching, and we'll see you in the next video.